Hey everybody, hope you're doing well. Welcome to this episode of NVTV. Today we are sitting down with Chris Olney, who is the Chief Credit Officer here at North Valley Bank, to talk a little bit about cash flow management for businesses. But before we jump into the details of that, Chris, why don't you give us a little background on exactly what you do at the bank and why it is that we have you sitting here talking to us about this?
Well, I spend a lot of my day reviewing loan applications for businesses and overseeing others that do that same process. So I spend a lot of my time reviewing financial statements, loan requests, and making credit decisions, making decisions as to approval or denial of loan requests.
Okay, and so as we're talking about sort of helping a business owner look at their business, I mean, obviously that's kind of revolves around the financial statement, which is really the crux of what you're looking at as you're making those decisions and going through your daily job.
Right.
So in essence, you spend most of your time pouring through financial statements.
Yeah.
Doing this kind of analysis.
Yes.
On the bank side of it.
Yep, definitely.
So let's start sort of really basic. How would you define cash flow, and why is it important, particularly as a business owner, to be monitoring or aware of?
So I would say cash flow is kind of the movement of money in and out of a business. So money coming in would be your customer pays you for a product or service that you've provided, and the money going out would be just to pay expenses, rent, loan payments. You're probably going to have to either repurchase inventory or produce inventory so that you can resell it to the customer. Those types of items would be outflows. So depending on how your business is structured, you may offer terms to your customer. So your customer may buy a product or service from you, and you're going to allow them a certain period of time to actually pay you back. Those are called accounts receivable. So that's cash that you're going to collect at some point in the future, typically 30 days or less. Sometimes your suppliers or your vendors also give you credit terms. So if you buy a product or material from them, they might give you a period of time to pay them back. That's called accounts payable. Again, typically that's 30 days or less. So the timing of your cash may not necessarily line up with either the sale to the customer or the purchase of the material.
Okay. And I guess that's one reason that's important, depending on the business. A lot of businesses probably on what we call accrual accounting versus cash accounting. Mm-hmm. And if you're on accrual accounting, ultimately what happens, and correct me if I'm wrong, is that your income statement can show one thing, but your actual cash flow can show a different picture.
Yeah, you know, early on I kind of learned the phrase cash is king from the underwriting standpoint, and that just really boils down to what you're saying. I mean, cash is what pays the expenses, cash is what makes the loan payment, and as a business owner, you want to put some cash in your own pocket as well for the efforts that you've made. So it's really important, I think, not to focus on, I mean, you can't ignore, but don't overly focus on the sales side or the expense side, because as you said, I mean, you could have a net profit on paper, but not have any cash to speak.
You've got receivables sitting there, which are reflected in your income, but nobody's paid you yet.
Exactly.
So you have nothing in the bank to pay your staff or your
Exactly.
vendors. Or what. Okay. So as a bank, what is important about a cash flow statement or a cash flow analysis? What are you particularly looking at, and why is it so important?
Selfishly, from the banker standpoint, if we're going to make a loan, we want to have some assurances that we're going to get paid back. I mean, we typically aren't going to make a loan and not hope to collect those dollars back plus some interest. I'd say one of the most important probably ratios or that we look at is debt service coverage. So basically we want to know how much cash flow you have versus how much debt, monthly payment, loan payments specifically. Most banks will look at what I kind of call a traditional cash flow method, and we'll look at it from a historical basis. Mm-hmm. So the customer will provide us, as part of their application, a couple of years of their tax returns, hopefully maybe a current income statement as well. So the traditional cash flow is basically net income plus depreciation plus interest. We'll take that number and we'll divide that by the debt payments. And again, typically we're looking at that on an annualized basis. Most banks would want to see that ratio at 1.2 to 1 or better. So in other words, for every dollar of debt that the business has, we'd like for them to have $1.20 of cash flow.
That's debt payment, correct?
Correct.
Not actual debt, right? You may have
Yes.
$1 million loan, but
Yes.
you don't need $1.2 million in income.
Right.
We're looking at whatever the payment on that debt is.
Correct.
Okay. Okay. And obviously, maybe it's obvious, maybe it's not, but that 1.2, from a banking perspective, is after the bank has extended the loan.
Yes.
You want to be at 1.2.
Yes.
So theoretically, coming in to get a loan as a business owner, you need to be even better, sitting better than 1.2
Yes.
when you apply for your loan.
Yeah. And that ratio includes not only the loan that we're contemplating at the time, but any other loans that you have as well.
Right. Okay. So as a business owner, obviously it would be good to know that you can cover more than just your debt payments, but what other sort of numbers would be helpful to be monitoring, or pieces of the income statement or cash flow statement would you recommend a business owner or anyone who's running a business be sort of monitoring on a quarterly, annual, monthly basis?
So, there's a couple of items that really impact cash flow. So one we've talked about is the income statement. So, you want to obviously you want to monitor revenues. You want revenues to grow, but you want to monitor the expense side as well. So, one line that we look at is gross profit. So that's, what's the total revenues, subtract from that the cost of producing or purchasing that item that you're going to resell. So obviously you want that gross profit margin to be as high as possible. So kind of controlling what are my expenses in producing or purchasing that product or service will have a positive impact to cash flow, as well as all the other expenses, salaries and wages, rent. The better control that you can have on those items, the more dollars that are going to flow to the bottom line on the cash flow side of it. Kind of looking at the balance sheet, and this is going to, this won't apply to every business. This is only really going to apply to businesses that offer their customers terms or sell an inventory as well. But you want to, fluctuations in those balance sheet items are also going to impact cash flow. And we typically are looking at a few ratios, a current ratio, a quick ratio, working capital, and we're really kind of focusing on current assets and current liabilities. So a current asset is something that's going to convert to cash within a 12-month period. So that's accounts receivable, and that's inventory, probably the biggest too. Yeah. On the liability side, it's typically accounts payable, so amounts that you owe your vendors or suppliers. It could be accruals, which could be items that have to be paid at a future date, payroll taxes, those types of things as well. So there's some components there that impact the cash flow as well. So speaking of the working capital ratio, that's basically current assets less current liabilities. So you want a positive number there. You want to have more dollars in the coffer than you owe on that current side. Also, current ratio would be current assets divided by current liabilities. Typically you want to be at a 1-to-1. Again, you want to have enough assets that are going to convert to be able to cover those liabilities. Quick ratio is you back out the inventory side of it. And so typically the ratio could be a little bit lower there.
So at the end of the day, it's just really getting a good handle on, and these ratios are tools to be able to get a good handle on, again, the money coming in and the money coming out.
Right.
The actual cash, which, like you said, cash is king, rather than just, my income statement says I've made $1 million this year, but it's sitting in payables, which hasn't even, or receivables, which hasn't even come into me yet. So,
and another, a couple of other ratios that we like to look at are accounts receivable turnover and inventory turnover. So how quickly are we collecting those receivables, or how quickly are we selling the inventory? Clearly, the faster that you can collect those receivables, the faster cash is coming in as well.
That helps you project out, I would imagine. So, and I would think having a really good and working budget is crucial to this as well. Is to have a budget annually, but then not to just put it in the drawer and never look at, hey, how am I actually faring against my budget? And that probably becomes even more important when you've got a larger business that begins to have departments and department heads that are responsible for budgets. Somebody has to be looking at the whole picture. Otherwise, you get a department head over here who knows he has X amount of dollars to spend, and he spends it not knowing that we don't have the income to support it anymore, and that never gets revised and never tracked and managed. So,
and kind of back to what you were saying, I mean, the net profit isn't necessarily what's going to pay the bills, so to speak. So having that monthly cash flow budget projected forward is critical. Yeah. And following it, like you say, don't make it an annual exercise that you just kind of forget about.
Right. And I think that's important because there are people who are sort of numbers people, and for those of us who are, that it's kind of second nature to be tracking that stuff. But for a lot of business owners, your passion and your love is whatever the business is and what you're doing, and bookkeeping and accounting, you just want to shove over to the side and let either a bookkeeper or a third-party accountant do, and not have to think about. But you can get yourself in pretty big trouble pretty quickly not doing that.
Yeah, there's been a lot of clients that we've worked with over the years that they kind of they don't really monitor their business until it's tax time. And here's my shoebox of receipts for my tax accountant to prepare that statement. But you've really got to track. Yeah. Maybe in their mind they know, hey, revenues, my sales are going up each month, so I must be doing fine. You kind of treat it like your checkbook. Right. You want that number. You want to track each incoming and outcoming item, and you want that number to be positive.
Right. You're in trouble if it's negative.
Yeah, you do. Yeah. Eventually.
So what are, aside from not managing and just not paying attention, what are some issues or obstacles, concerns that you see businesses having, whether it be things like seasonality or even sort of economic cycle issues, where people start to run into cash flow issues that are maybe beyond their control necessarily, or just for the nature of their business?
Yeah, I think, one of the items is just not having that nest egg, so to speak. Have some money sitting out there in your money market account or in your checking account, so you have a cushion. That cash stabilizes your company, and it also, as you say, when there are lean times, you've got that to fall back on. But it also gives you a quicker reaction to an opportunity. That if you have that cash to fall back on, kind of hand in hand with your question on seasonality, clearly, understand the seasonality of your business and sock away some money for the slower times. Be cautious on how you're growing your company. Be pretty clear, pretty certain about when you're spending dollars. Make sure that you're going to get the appropriate return on your investment for that. Growing for the sake of growing isn't necessarily the best thing. Growing companies have probably higher cash flow problems than a stabilized company.
I mean, as you usually are expanding your expense side before you can drop money to the bottom line on the income side. So as you grow, you're kind of stressing all those numbers. What are some of the problems you see, kind of again from a banker standpoint, aside from sort of just the numbers, or sort of, I guess, things that would be red flags that would make you question whether or not a business is worthy of lending money to?
So this would be sort
of like management issues, or hey, this company's not good at this, or this is mismanaged here, or I mean, are there typical things that people forget or don't do, or is it really just down to the numbers? And if the ratios are in line?
Now, I mean, we have the advantage, I think, at a bank like this where, we're able to sit side by side with the customer, and, we want to get a sense of the character of the borrower, the management ability. So being able to have that kind of that one-on-one conversation is beneficial. We'll do things like, as part of the application process, we'll pull a credit bureau report on the owner. We might pull a business report. We might ask for some references of suppliers or vendors that we can talk with, just to kind of get a sense of, how you're paying others could be a sign of how you're going to pay the bank.
Right.
Take advantage of your banker as a consultant. Take advantage of your accountant as a consultant. Take advantage of the Small Business Administration or the Small Business Development Center to help you form your plan. And we all can't think of every situation or every potential obstacle. More heads are better than one, I think.
Sure. So let's talk a little bit about sort of the services or the tools that are out there for business owners. I mean, obviously generating income and cash into your business through the operation of your business is ideal, but what other tools are there out there for businesses to use to help with cash flow management?
Maybe talk just about a couple, as far as maybe things that you can do to either obtain your cash from receivables more quickly, or maybe delay payment to your vendors. A lot of companies will offer their customers terms. So you need to pay me in 30 days, but if you pay me in 15 days, I'll give you a 10% discount. So, yes, potentially there's a little bit less coming, but you're getting it quicker. Talk to your suppliers and your vendors. Will you offer me credit terms so that I don't have to pay you for cash on delivery of that product? So again, that you can hang on to that cash a little bit longer. Banks will offer lines of credit. So again, that helps you kind of bridge the gap, the timing gap. There's a source out there, it's called Risk Management Association, and basically they will compile different ratios for different industries. So they'll break it down by different industry types, and they'll say, okay, for this business in this industry at this revenue size, typically their accounts receivables turn on 45 days, or their inventory turns every 100 days, or their gross profit percentage is X. Look at those numbers and compare them to how you're doing. I mean, can I do better? Can I, if the industry's collecting it 28 days and I'm collecting it 35, maybe I need to work harder on that. And turning those items around faster has a huge impact on the cash flow.
What, going back to the line of credit as a tool, what sorts of businesses tend to be good businesses to take advantage of something like that?
Again, it's kind of back to somebody, a business that has balance sheet fluctuations where you're offering terms. So, I've sold the product today. I'm not going to get paid for it for 30 days, but I need to buy more of that product or produce more of that product so I can resell it. Yeah. So that helps that business expand and grow.
Would that be a good tool for again, back to sort of like a seasonality, or, I know I've got a lull and during the, say the cold winter months that my business isn't, wherever I've landscaping, for example, where you just have a line of credit established to be able to pull during that time to get you through the lean times.
Yep.
But again, obviously I would, you're not going to lend or extend a line of credit to a business that isn't sound as a business. So it's not like you can just come in because your business is failing and expect to get a line of credit.
No, I mean, from the banker's point of view, a line of credit is probably one of the more risky loan products that we can offer because, as you say, it's got to be it needs to be used properly. It needs to bridge just short-term gaps in that working capital. Sometimes that line's not used properly. It's used for, purchase a piece of equipment, or, fund losses.
Right. Yeah.
So typically there's not the monitoring on the bank's side to really have a good understanding of how that's being used. So you're right. I mean, it's the business needs to be sound. There needs to be a good plan. There needs to be capable management, that type of thing.
Okay. Well, what other tips or insights would you have for either someone who's thinking about getting into business and really getting their feet wet with this topic, or even someone who's been around for a while and may know something about cash flow management, but maybe missing a piece? Is there anything else that you want to throw out there?
Just kind of go back to what I said. I mean, just take advantage of those sources that are around you. Having a good accountant that's going to do more than just your annual tax returns, or having an attorney that's going to help you is it's probably money well spent.
Yeah, it's a good expense.
Talk to other business owners, successful business owners. I mean, if you're not in direct competition with them, I've found over the years that business owners love talking about their business, and they typically, they want others to succeed as well. So, I mean, there's a great source.
Right. Of course.
But again, talk to your bank, talk to your accountant. We've got a local small business development center. You can take advantage of that as well.
All good resources.
Yeah.
Chris, you know this all stuff really well. For someone out there who's just getting started, some of these terms that we've talked about, the ratio, some of the sort of the weeds of the issues probably aren't real well known. So if you have any questions, please drop them in the comments below the video, and we will get back with Chris and get you answers. We want to make sure that you have all the information you need to manage your business well. So let us know what questions you have. All right. Well, Chris, thanks so much for sitting down with us. There's a lot of really useful information. Hopefully you're able to take something from that and manage your business a little more wisely. And so thanks again, Chris.
You're
Thanks to all
welcome.
of you for watching, and we'll see you next week on NBTV.